Hello everyone and welcome back. In today's video, I'm going to go over the 3 reasons why it's going to be very unlikely that you or myself could beat the crypto market by trying to handpick different cryptocurrencies. Now, I know this is something that we all love to do. It's fun to speculate on projects, to do research, and to really try to pinpoint what the future of innovation will be like in DeFi. But at the end of the day, this is very difficult to actually do accurately, and it's almost impossible. Trying to handpick cryptocurrency winners or any type of assets like stocks is really hard to do, and it's almost impossible just to beat the overall market's average. Now, there are, of course, many reasons that this is the case, but I'm going to stick to 3 important facts as to why you probably can't beat the average return on the cryptocurrency market. I should mention the caveat that it is, of course, very possible to get lucky or even to outperform the market in the short term, but over the long term, we would never expect to see that individuals could really beat the market's return. This is, of course, a very accepted philosophy in the stock market, but I think a lot of people in cryptocurrency really think they can get an edge on the market. So I hope this video is helpful and it clears up different misconceptions. Now, before I get started, please consider liking the video and subscribing if you haven't yet. All of those actions really help me out and they will encourage me to create more content. So the first reason why it's going to be very difficult for any one individual to handpick different assets and beat the market are just the basic principles behind diversification. Now, I'm going to keep this video at an accessible level, but if you choose to dive a bit deeper, the link to this paper is below. It's called Risk Reduction and Portfolio Size: An Analytical Solution. And the paper basically goes into the pros of diversification, and it actually talks about how quickly diversification happens. I completely understand if you don't want to read the whole paper, and so I will just link you also to this Wikipedia article about diversification. Now, this Wikipedia article references that paper, and I think it gives you the most important takeaway in just a few short sentences, so it's very helpful. Now, in this example, they're talking about the stock market, but I believe that can be translated over to the cryptocurrency market because, again, we're just talking about risky assets here. It doesn't really matter what we're talking about. So just to break down this table, on the left we have the number of stocks in your hypothetical portfolio, and in the middle we have the average standard deviation of annual returns for your portfolio. What's really interesting is as you start to pick up more assets, we can also think of them as cryptocurrencies. If you have 1, your standard deviation is 49%, but jump to just holding 6 stocks in your portfolio or cryptocurrencies, and your standard deviation is already down to 26%. What's even more fascinating is if we compare that to the number of holding 1,000 or 500 stocks in your portfolio. You can see the standard deviation really isn't that different. So this paper actually finds that just holding 4 random stocks provides almost the same amount of risk protection as holding about 1,000 stocks in your portfolio. Now, we can obviously transfer this to cryptocurrency. There are hundreds of different cryptocurrencies out there. And so the idea that you can pick just a few and outperform the market is really going to be challenging. Sure, you can definitely get lucky if you handpick one asset and it beats the market significantly. But once you start picking 2, 4, 6, 8 different cryptocurrencies to invest in, at that point, you're just going to match the market's return. Of course, it is possible to get lucky and maybe you pick the 4 or 6 or 8 best cryptocurrencies out there, but that's really unlikely and I wouldn't expect anyone to actually be able to do that in practice. Another way to think about this diversification principle is using the concept of beta. So beta is a measure of an asset's volatility relative to the entire market, and so all assets have some type of beta attached to them. To make that a bit more clear, let's just assume there are 100 cryptocurrencies in the world. If we basketed all 100 of them together, the natural beta of that would be 1 because that's the whole market's performance. But if we were to handpick an asset out of that, like ETH or Ethereum, the beta on ETH would be slightly higher than the entire market because we're just talking about one asset here that's going to be a little bit more volatile than the overall trends of the market. That volatility goes, of course, both ways in the upside and the downside. But what's really important to note here is that all assets are going to be correlated with the overall market's performance. It's going to be very hard to find a cryptocurrency that's uncorrelated to BTC, for example. Now that we've gone over diversification, beta, and the correlations between assets, we can move on to the second reason why it's going to be very hard for you to outperform the overall cryptocurrency market. So the second reason why you're probably not going to be able to outperform the market is actually because of taxes. So this is going to take a US-centric approach, but I know a lot of other tax codes have similar capital gains tax structures to the US, so you can probably apply this to your home country as well if you're not based in the US. Now, just a quick briefer on capital gains tax in the US. There is a difference between holding an asset in the short term and the long term. So if you hold an asset for 1 year or less, you're going to be taxed at the short term capital gains rate. Now, the short-term capital gains rate on the federal level is going to be equivalent to your normal income tax rate. For most people, that could be about 30%. Now, this short-term rate is just the federal rate, so your state might also have a capital gains tax attached to it. In California, I believe it can get up to about 13.3%, which is where I live. Now, next up is the long-term capital gains rate, and this is if you hold your asset for longer than 1 year. So the tax rate for long-term capital gains is lower than the tax rate for short-term capital gains, partly because the government wants to incentivize long-term holding, which is much safer overall. And you can see in this chart, long-term capital gains is based on your income, so it can be anywhere from 0% or 20%. For most people, it's going to be 15%, but of course that varies depending on your income situation. In addition to this, you're also going to have your state capital gains tax. So you might be wondering, well, how does this actually impact me if I'm trying to handpick different cryptocurrencies and beat the market? Well, I built a quick spreadsheet here just to highlight the difference between two options of just trying to hold one asset that basically captures the performance of the market versus trying to handpick different cryptocurrencies. So this is a very basic example, but you can see in option one, this is going to be a long-term hold. So in this example, I purchase ETH on day one at $1,000. I hold it for exactly 1 year or 1 year and 1 day, and I'm very lucky. ETH goes up 3x in value, so it's now worth $3,000. Now I'm going to be taxed at the long-term capital gains rate here of 20%. Again, that's the highest bracket for long-term capital gains. Most people are going to be 15%, but I just put it at 20% just to factor in your state capital gains tax. So assuming all of this happens and I pay my taxes, I'm going to net $2,600 after that 20% capital gains tax. Again, just remember you're only taxed on your gains. So I'm only taxed on that $2,000 profit. So I'm going to net out $2,600. Now, option two is a bit different. This is me trying to handpick an asset to try to beat the overall market performance. So in this example, I bought ETH at $1,000 and I'm actually holding it for 6 months. And I'm also lucky in this example, and ETH went up 2x in price. So now ETH is worth $2,000 and I'm looking at a token like Luna. This is just one example. I don't mean to pick on Luna. It's a very fascinating project, but I want to purchase Luna. And so I purchased Luna with that $2,000 of ETH. Well, two things happen here. So the first is I'm locking in capital gains of $1,000. And so I'm going to have to pay $400 of capital gains at the end of the year. The reason for this, number two, is that it's a short-term holding. So I'm only holding this for 6 months and I don't get that long-term capital gains bonus. But maybe in this scenario, I'm very confident Luna is going to beat ETH. And so I decide to put my $2,000 in it. And so at the end of this year, I've now held Luna for 6 months, and I was really lucky. I was right in this example, and Luna actually 2x'd again. So now I have $4,000, and I'm going to sell that, let's just say, to USD. So now I have a capital gains of another $2,000, and with that increased short-term capital gains tax rate, I actually owe $800 of capital gains on that Luna. So if we add up all of the taxes I owe and the increase from the short-term capital gains here, you can see that I'm now netting out $2,800 after tax. Now you might say, well, this is better than just holding ETH. I'm getting $200 more at the end of the year, but was it really worth that extra risk you took on? We know assets like BTC and ETH pretty much set the tone of the market, and is it really worth that extra risk of Luna when it's clearly more speculative? Is that extra speculation and risk worth just $200? In this example, I would say probably not, but of course that depends on your risk tolerance and situation. So that's the second problem with just trying to pick assets, and that's that you're going to fall in this short-term capital gains bucket more often than not if you're trying to switch between assets and handpick different currencies. If you're going to be picking different assets, you really should be holding them for a longer period of time over 1 year. With that said, let's move on to the third reason why you probably can't beat the overall market returns. So the third reason why you probably can't beat the market's return is there are just so many unknowns out there, and no matter how much research you do, there's always going to be external factors that impact the quality of your investment. These are unexpected, and I think one of the best examples of this is Ripple, or XRP. So Ripple was, of course, backed by a number of institutions. It was considered a blue chip in crypto, and people were really excited about what they were building. But what of course happened was the SEC actually charged Ripple for an unregistered securities offering. So they were basically saying Ripple was selling a security, and that Ripple was saying, well, it's not a security, it's just a cryptocurrency. Now, this is of course impossible to plan for. You just can't predict this. No matter how exciting the technology is, these things do happen. And you can see that's reflected in the price chart here. Ripple is now down 84% from its all-time high. What's interesting to note is the people that invested in this, they didn't necessarily make a bad decision by picking Ripple. They just couldn't predict these unknowns that would happen. When you start handpicking different assets, you really expose yourself to these black swan events that, again, you can't research for and you can't protect yourself against. This is just another reason why, in my estimation, you can't beat the overall returns in the market. And again, those are going to be dictated by BTC and ETH at this point. In all fairness, Bitcoin really does set most of the market, and so it's going to be hard to outperform Bitcoin at this time. So I've talked about these three examples of why you can't beat the market. And just to recap, that's one, how quickly diversification comes into play. So if you're going to try to beat the market, you have to do it with just a few assets, maybe even less than three. Two, it's the tax disadvantage that you face by trying to pick different assets to buy into and sell. And three, it's just the uncertainty of unforeseen black swan events, which are actually quite common in crypto. So with all of that said, what can you actually do to protect yourself if you believe in the long-term viability of cryptocurrency as an industry? Well, what I would say is the best approach is you're going to want to hold the blue chips like BTC and ETH, and you're also going to want DeFi exposure, but you're probably not going to outperform the DeFi market by handpicking a different DeFi token. So the best option here is to hold a basket of DeFi tokens like the DPI or the DeFi Pulse Index. You can see here, this is the DPI. It holds a basket of the following different DeFi tokens, and I would say most people are not going to be able to outperform the DPI if they're trying to handpick different DeFi tokens. Now, in addition to holding BTC, ETH, and the DPI, if there are some projects you feel strongly about, like Terra or Luna, you can purchase those tokens as well. But just don't expect that you're going to be able to outperform the market by just holding, say, Terra and let's just say Aave, for example. It's going to be very hard to pick specific projects that are going to succeed in the future. Again, it's possible, but just make sure that you're not confusing whatever luck you might have with actual skill in picking assets. The better decision would have probably been to purchase DPI and just to ride the DeFi market as a whole. So that's all I have for you today. I hope this was helpful and I hope you enjoyed the video. If you did, please like the video, subscribe, and hit the notification bell. Again, all of those things really help me out. So thank you all so much for watching, and I look forward to seeing you all in the next video.